Hello, everyone. On behalf of the Counselors of Real Estate, welcome to this presentation of institutional investments, uncertainty, enemy or opportunity. Thanks for joining us today. I'm John Henschel, CRE Global Chair of the Counselors of Real Estate and President of Henschel Real Estate Services in Abingdon, Maryland. The Counselors of Real Estate is a global organization of commercial property advisors addressing real estate challenges worldwide. Experienced, innovative, principled, and credentialed problem solvers, counselors reside in 22 countries, practice in many more, and offer expertise in over 60 real estate disciplines across all asset classes. Each has earned the prestigious CRE designation, representing a badge of distinction and a commitment to excellence. Let's recognize the exclusive sponsor for this event today, Equus Capital Partners. Thanks to them for their partnership with CRE. Before we begin, I'd like to offer you a free digital subscription to the Counselor's peer-reviewed professional journal, Real Estate Issues. It's been named one of the top 10 essential real estate publications in the United States. Please visit cre.org/REI to subscribe and obtain your free subscription. You're encouraged to utilize the Q&A feature should you wish to submit a question. Your participation is welcomed, and we'll answer as many questions as time will allow. I'd like to introduce today's moderator, Lisa Strope, CRE, Vice President and Director of Research for TA Realty in Boston. She is also a co-chair of the Urban Land Institute's Women's Leadership Initiative Council. Lisa was invited to membership in CRE in 2023. Welcome, Lisa.
Thank you, John, and thank you for the introduction. I'm very excited for our conversation today. We have amazing panelists really coming at the institutional real estate market from different corners. So very unique set of outlooks on where we are today. And we're going to structure this conversation around three different areas, really looking broadly at the macro environment, what we can learn from what we're seeing today. We'll take a look at the equity capital markets, touch briefly on the credit markets, and have some conversations around fundamentals for certain sectors, speaking today, and asset classes. But before we kick off, I want to take a moment and let each of our panelists introduce themselves, and I'll start with you, Christy.
Thanks, Lisa. Hi, everyone. I'm Christy Fields. I lead the real estate consulting practice at Makita Investment Group. We are a general consulting firm providing services to institutional investors across all asset classes. I'm based out of the Portland, Oregon office, and I am a member of the board of the company and also a shareholder.
Thank you. Moving on to you, Steve.
Hi, I'm Steve Coyle. I head equity capital markets and investor relations at Davis. We are a fully integrated owner-operator developer, primarily in the value add space, with an emphasis on Greater Boston, where we're located, and up and down the Eastern Seaboard, as well as some other national markets.
Michael, thank you.
Hi, I'm Michael McGowan. I'm a portfolio manager at the California State Teachers Retirement System in Sacramento. We have a kind of diverse portfolio of about $47 billion in net asset value. The majority of that is in JVs and separate accounts, but we also invest in funds, co-invests, and other vehicles. So happy to be here.
Thank you. Hans?
Hans Nordby. I lead research and analytics for Transwestern. Transwestern is a national broker and manager and services firm, as well as an investment manager and a development firm. So a diversified real estate services firm. And we specialize for the most part in industrial, multifamily, and healthcare on the investment side.
Thank you all. As I said, I'm excited for this panel because everyone touches the institutional market from a different view, and I think we'll have a very robust conversation today. So to kick us off and take a broad look at the macro environment to sort of set the stage for our conversation without predicting where we think things are going in this very fluid time, let's look to the past and think about the past and where we've been and what we've all gone through in our careers. Are there elements of the current situation, this current environment, politically or economically, that you've seen before? Rising yields, volatile equity markets, widening credit spreads. Are there similarities today that can help us navigate where we're going? And I throw it out to you guys to see who wants to kick off.
Well, I can kick off, and it'll be so high level that anybody could react to it. So I'll make this easy. Yeah, I do see some similarities between today and previous periods. And I would mention when FDR and Reagan came into office. I'm not saying that to endorse those presidents or the current one. I'm saying it's not just a little bit of an economic blip. It's cultural, it's structural, and it's different. So I wouldn't have said this for most of the elections in my lifetime. And structural. Right now, government spending is a little over 23% of GDP, even though the economy is booming. And at the same time, we're running a 6.3% deficit. That's a structural thing, which probably ends at some point. So yeah, there are some historical precedents, and they're not a lot of fun. I'll turn over to the rest of the panel to react to that one.
I guess I'll jump in after you, Hans. Being a recovered researcher, so I'll follow the researcher. So, I've been in this business about 38 years. John Davis, our CEO, has been in this business 49 years. And I think across the board, when we have discussions at investment committee, I think we all agree we haven't seen quite this. There are elements that we've seen. There's clearly some distress in the community and regional banks. That's happened before. And from that, as John says, sometimes people have to kill the healthy chickens to feed the sick chickens. And so that creates some opportunity that we've seen where you can buy some good assets at yields because it's the only thing that someone has to sell. On the other hand, I don't think we've ever seen this kind of, at least from the federal government, this kind of on again, off again policy that we've seen before. And that makes things uncertain. Typically with uncertain times, that leads to increased volatility. It leads to increased opportunity. I think that remains to be seen because the volatility is so much day to day that it's really hard to underwrite. I think it makes us at least, think of lots of contingency plans. It doesn't stop us from doing business, but it makes us more careful and it makes us have different options. Like you might acquire the land, but you're going to look through various scenarios of do you go ahead with vertical development or do you not? How long can you wait? Those types of things on a development project as an example. I also think that this seems to be a much slower recovery. So it feels a little bit in some respects like the early 90s. I hope it's not going to be that long. But it doesn't seem like everything is resolving as quickly. And the other thing that I think is different, and I think this is different every cycle, is the banking institutions, the Fed and others have learned that they've learned the lessons from the early 90s when they let banks blow up, had the RTC, went through that. They've learned the lessons from what happened with the GFC. And so I think that the extend and pretend is a real phenomenon that has helped the financial system in the long run, but also it delays a recovery, unlike in some other downturns. Couple of thoughts.
So, Steve, I'd never heard the chicken thing before, so that's thank you for learn something new every day. I agree with both of you. I think something that's similar, right, is I think folks forget that the decade before 2008, U.S. 10-year treasuries were at 4.7%. Like we've operated in a higher interest rate environment before. That said, cap rate spreads to treasuries were kind of in the 280 to 320 basis points, and now we've got them in much, much tighter, 100, 110 basis points. So I think that's why things feel still pretty expensive if they've not been marked, which is a challenge in today's market. But the other thing that's interesting, and I think different a little bit, is that we have pretty strong fundamentals underlying in the market today. So it's really a different blend of things that have been similar and disparate in the past.
Christy, specifically, what are you hearing from conversations with the LPs that you work with?
Yeah, it's a couple things. Most of our LPs are at or close to their target allocations. And so that combined with kind of the lack of visibility around and the lack of transaction volume really has most LPs in kind of a wait and see mode, not feeling any particular urgency at this moment to jump into the market in any bigger way than what would be called for by kind of prudent vintage year exposure and pacing plans. And to Steve's point, I think most people feel like this opportunity is going to be longer lived than this wall of distressed opportunities that or distress that perhaps people were calling for 18 months ago or so.
Does anything about the current environment change what LPs are looking for in their managers?
Well, I think the current environment is creating more dispersion in returns and dispersion in performance among managers. And I think that's been really helpful to us when those of us who are underwriting new investment opportunities currently, because anyone who has invested in multifamily industrial over the last decade looked like a genius. And so a little bit more dispersion in returns is helpful to us in trying to kind of parse talent from tailwinds. And so we're spending a lot more time doing that. But, basically we're still looking for the same things. We're looking for enduring talent. We're looking for alignment of interests. We're looking for, just the continued relevancy of strategies in today's markets.
Lisa, I have a couple thoughts to piggyback off of what people have said. First, I agree with Christy, and I think Steve had touched on about rates. To me, since I've been around since the times of I started during the RTC time. But to me, like the rates are just coming back to normal type levels. And as Christy touched on, the spreads are tighter. But I think you could say that that maybe the 30 or 40 years, whatever it is, of institutional real estate becoming a more mature investment class and showing how it's performed over time, you could justify saying that perhaps the risk spread to treasuries might be more acceptable than it was, say, 20, 30 years ago when it was more of an emerging investment class. To me, it's interesting. It used to seem that there's more supply-demand driven shocks to the real estate market that kind of characterize the real estate cycle, and there really hasn't been much of that. Compared to say the 80s or 90s type period. Most markets are relatively healthy, or if they get out of balance, they seem to, the discipline on new construction and lending and everything kind of helps them get back to normal within, say, 2 or 3 years, which is something that a lot of investors can kind of look through. So, like, for instance, we're actually, happy to do spec development right now in a couple different sectors, even though it doesn't seem to maybe make sense now, but if you're actually going to deliver in 2 or 3 years, the market probably better then. And then lastly, when Steve's touched on all about banks, what's different now is how fast the administration changes stuff. So the banks have been kind of in control and everything, but isn't it? I think it was just today or yesterday they came out and said that they might look at changing the reserve requirements to lighten up on everything. So kind of anything can happen nowadays. So.
And I think one thing I definitely agree with what Mike said and what Christy has said. And I think a couple things to add are, well, first, we think cap rates are high now, going to Christy's point, but I remember when I got in this business, and Christy and Mike and Hans got in this business, I had a mentor who said it's always a 7. We're not back at 7s yet, except for office and probably life science, some other assets classes. But generally, it's, we're not back at 7, certainly in industrial yet, although I would say cap rates are going up and, or in multi. So, they still are relatively lower. I also think in past downturns, it's been more systematic distress. And in this downturn, I think if you're investing, it's more episodic. It's there's something happening at the asset level or the management level. And the only other thing I think I would add is, in terms of how investors are acting, I think they're acting the way they've always acted. The one difference I see today in some of our investors, and this is true in our high net worth investors, but as well, a lot of our smaller foundations and endowments and a couple of the pension funds are, a focus on DPI more than in past cycles, because they've invested heavily in private equity, they've invested heavily in real estate and other real assets, and the distributions just haven't been there the last several years. And so, I was talking to one of our investors and I said, it sounds like for you, DPI is a new IRR. And he was like, absolutely, put that on your wall.
Yeah, we hear the same thing, that IRRs without distributions are just a fantasy, right? So there's nothing to make it real, like returning capital. We also hear more comparisons broadly to other private equity types, private equity broadly, debt. So, being commercial real estate used to mean you were in one of 4 property types and you compared yourself to yourself. I don't think that's true nearly as much as it was before, especially for the large institutional investors. The comparisons are broader. But I think over time that could work in our favor. Right now, supply is down. As Steve and Michael said, there are markets where new development makes sense today. And looking back 20, 30 years, if you look at vacancy rates in a lot of institutional industrial markets, well, they're sort of at normal levels today. They're just not 3%. So historically, you'd develop there. So I would agree. There's a lot of operating fundamentals that are pretty normal. It's the rest of the environment that seems a little different.
Well, queuing off that question then, Hans, I want to drill down on that a little bit more. I think, across property sectors, arguably industrial may be the most impacted from the changes in the global supply chain. How much do you think the changing tariff policy is going to impact the industrial market?
Well, I could speak to what the way we're approaching it, which is we're looking for tariff tolerant markets. I call it the tariff tantrum, and we'll see what it turns into. Nobody knows what it looks like on the other end. But if you're looking at markets that have local population growth, they have already industrial demand growth, and they've got good bodies times dollars math in the catchment area of their distribution center, those are markets that should do well in either scenario, as long as you have all of those things. That description doesn't describe the Northeast US, but the Northeast US, some of those markets have great barriers to supply. So there are positives and negatives, but right now we're focused on markets that pretty healthy, bodies times dollars work distribution, they win either way. So if you take a market like a Houston, ready access to lots of labor, in-migration, population growth, and if their tariff regime is the same as it was, a week ago, changes all the time, then if we have low tariffs, say, then it's a port market. It does well. We have high tariffs. Port doesn't help you anymore. You've got a lot of local production. And so these are the types of markets that I think are interesting right now. And I think right now matters. Vintage wise, we don't know if it's the bottom, but it's interesting that all the major property types in the NCREIF index went positive in the most recent quarter. So I don't know if somebody rang that bell. Right. Exactly, Lisa. So nobody rang the bell. And we could have a recession. Things could go bad for sure. But vintage wise, I think if you're dollar cost averaging, you don't want to miss the next 2 years. I also agree with what Christy says. It's not a wall of maturity. It's not going to happen overnight. But that didn't happen last time either. It always looks like a wall of maturity and always gets kicked forward just a little bit. So I would agree with her there. But I think right now, supply is down. We have markets with good fundamentals. And most of us on this call, we're investing on a 5 to 7 year basis and selling to somebody who's going to be thinking on a 5 to 7 year basis. So we need to take the long view. And so I think there are some tough stories in some coastal port markets in the short term, but that doesn't mean you sit out the market.
I'm just going to pile on there. I think that's That's right. We're in a private illiquid asset class, and I'm not sure anybody wants to make a bet on what's going to happen in the next year or so. I would be really reluctant to tell you what the new normal is going to be. But so I think really focusing on quality assets and really strong fundamentals. It's really basic, but that here we are. And I think to the extent that tariffs continue to be inflationary around input costs to new development or deep rehabilitation of properties, that just inures to the benefit of quality existing assets and their ability to push rents, as we go forward.
Which brings us to arguably maybe the most troubled sector, and I think it's worth talking a little bit more about what you mentioned, Christy, quality assets, how you look at the office market. Are we calling this the bottom for the office market now that office has ticked out its first quarter of positive returns?
I'm not smart enough to call the bottom in any sector. And I think the office sector is unique in just the wide variety of quality of product and location. And so I think we're just having a rationalizing of office space, just like we did in retail over the last decade. We've underwritten office recently. I mean, I think there's really high quality office out there, and there are some markets where it's really hard to find space over 10,000 square feet. It's very competitive. And so really, I think the office sector is just a matter of, understanding individual assets, the demand for that type of space, the amenity package, the neighborhood, that sort of thing, just the old fashioned good real estate fundamentals.
Yeah.
But back to my, we don't know what the new normal is. At first, the normal was everybody in the office 5 days a week. And then the new normal was no, everybody's going to work from home forever. And now the new normal is somewhere in between. So, it's hard to bet on those kind of decisions.
We've been paring back our office holdings. We had about, say, 70 traditional office buildings, and we've been selling 5 or 10 a year lately. The last 2 years, I'd say at least half of them we had to offer seller financing to get deals done, and even then it was rare to have a multiple bid situation. This year, I think we've closed on 4 sales, and they've all been all cash and decent sized sales. And now we're seeing more unsolicited offers, and even ones coming in at 10 or 20% over this quarter's appraisal. So there's some green shoots there, at least on the buyer, the investor demand, the basis buyers and things like that are very active.
So it's interesting. We've been in business 49 years. The first 35 years of which we primarily invested in office and multifamily, much more so office, primarily suburban. And then really around 2015, we stopped buying office and proceeded to try to sell everything in office we could. We own 2 office buildings today. One in downtown Pittsburgh. It's the best building, but that doesn't get you much in a market like Pittsburgh. And one in Miami, Florida, in South Beach, that's performed well. We haven't really looked at the office market. We started to over the last year. We have not transacted on anything. I would say that, some office markets, again, in parts, as Christy said, you have to look at the market and at the specific assets. But, New York City, Midtown, Class A plus buildings, probably maybe even the B plus are posting recovery. That recovery is much less strong in Boston, for example, where, we've historically operated along with New York. Pittsburgh is a mess. I was in Denver this week for ULI, and that market is seeing virtually no leasing across the board. So I think we are seeing across most markets a return to the office, but how the office market is recovering really is different market to market. And I think it still has a long way to go. I think there will be some opportunities created. It was said at the onset, we started investing in this fund in late 2022 that, we would have been in office. I know at least 2 or 3 of our largest LPs would have thrown up their hands. And I think now maybe one would, and the rest would say, I need to hear a story and it needs to be a good story. So it's not taboo. And just very quickly going back to the industrial, I think it's a good point. Is we actually closed this week on a transaction where we were the seller. It was a 1 million square footer in Savannah, Georgia, leased to Lowe's, a 750,000 square footer thereabouts, leased to a third party Chinese 3PL. So not exactly what you want in this market. And then 2 smaller distribution buildings outside of Boston and Wilmington. And that did close. It was a private REIT buyer. There was a slight retrade, less than 1% at the end. It was kind of where we agreed to. Cap rates, I would say, were certainly higher than we originally underwrote. The assets are priced on average below replacement cost, probably call it about a 5 3/4 cap rate on average. But part of that was we do think, and we hear from our investors, they want distributable cash flow. Also, there is uncertainty in those markets. If you look at the Odyssey Index, they are now fully, they were under allocated to industrial. Today, it's fully allocated. I still think there's other buyers like private buyers, like direct pension funds, like the non-traded REITs. But I think if you look at the Odyssey Index, it's now pretty full up on industrial. So it's interesting.
What are you seeing in terms of depth of bidder pools?
Yeah, that's a good question. So we went out with it as a portfolio. We also allowed and encouraged investors to bid on each individual asset because it actually crossed 2 funds. So we needed pricing on each asset. Ultimately, it was thin for the whole pool. It was widely looked at. It was thin for bidders on the whole pool, a couple. Mm-hmm. But on individual assets, there were 5 or 6 bidders for each of the assets. Even the Chinese 3PL, obviously things priced differently, but there were bids. I do think that some of those bids, though, we went through that bidding process prior to Liberation Day. I think some of those bids would have fallen out, had we launched the initial bidding, post Liberation Day.
And post Liberation Day, we've been in the market bidding in some non-port cities and markets with not as much exposure to the tariff tantrum, and we're finding what Steve described. 4 or 5 serious bidders at least, serious bidding action, even up until the end of last week and through this week. So I think people are looking through this. But only in select markets.
Well, and also keeping with the office theme for a minute before we pivot, Hans, what are you seeing in terms of leasing activity?
Well, leasing activity in 2024 should be up about 15% year over year. Surprisingly, not all the data's in yet. If you go to everybody's favorite data provider, it gets trued up over time. But a couple of takeaways. Overall, office leasing volume is down about 20% from the steady state we had for the 5 years pre-COVID. So if you look at the relationship to GDP to leasing volume, it used to be a very good relationship pre-COVID. And now it's just reset to a lower basis. But I would say to a lot of folks on the phone, I think a lot of CREs are in the brokerage community, that last year was up. And even though the office market has a lot of warts on it, leasing is a better situation. And, we definitely see stronger demand, as I think Steve was touching, or Christy rather, for best quality assets that are holding up pretty well. And I think that ties out to what Michael said about investor interest. So it's really a tale of 2 cities. I think there's just an ocean of B and C quality office that's like steel mills in northern Indiana. They will be padlocked and nobody will ever touch them again. And then there's a lot of really great stuff, like other industrial properties, that there'll be demand for. So definitely a diverse market.
It's certainly interesting times for the office market. I think broadly, one of the statistics that I've read is roughly 20% of the office market may be obsolete today, may get worse tomorrow.
What's interesting, I think everyone's saying that, there'll be a ton of conversion opportunities. We actually are doing one, but we've looked at, I bet you it's somewhere between 50 and 70, and we have found 2, maybe 3 that would have worked. The one we're doing was an office building built in the 40s in DuPont Circle in DC. Now we'll decide whether or not when we go ahead and start the conversion, but we were able to get all the tenants out in just a couple of months. And it has 4 sides of light and air, and it's a great location near GW, near the embassies, but it's in DC, and now you have the Doge effect. So, like I said, you've got to build in flexibility with all these things, because it's just the market feels like, it can throw you a lot more curveballs. But that asset worked well. It worked well. We're going to redo the windows, but it had great fenestration. We don't have to do any additional vertical penetrations. And when we start to look at most assets, that's not the case. The units are too deep. They're too small. They're quirky. This one happened to work, but I don't think it's the panacea that everyone's saying it is out there.
Yes, I think I agree with you. It's far more challenging than it appears to be, and unfortunately, it's not the easy solution everyone wants it to be. But speaking of redevelopment and development generally, I think Michael, you mentioned you're doing some development today. Steve, I know you guys are doing some development, but arguably the construction industry is one of the industries that is going to be most affected by the post April 1st announcements about changing tariffs. How are you managing development pipelines today? What are you hearing from your developments underway about managing risk?
We've had we're doing spec industrial. We're not doing much lately on traditional, multifamily development. We're buying those instead. But we do quite a bit with for sale housing, and we've had a lot of work done by our partners and consultants on the tariff impacts of how much it might cost per unit, per house, basically. And it seems like it's a manageable amount within the profit margins are high enough now. They're above where they usually are. And this would just kind of bring it back to more normalized levels for the builders and the demands there still. But generally, we're just trying to ask our manager partners that are doing development to basically increase the contingencies, so by quite a bit. So it's probably more developments we're turning down still as well.
Go on. Go ahead, Christy. You're gonna say something? No. So we're being, more cautious for sure, but I will say it's interesting. It's a pretty complex web, because right now, leading up to this, there was already a decrease in development, even really from the early part of this year, end of last year. And so the subcontractors generally are very, very hungry. And so they don't know where the next job is coming from. And we find this across the subs, even in the general contractors as well. And both, it's not just union, it's non-union, it's both. And so we've been able to drive better pricing from the subs over the last, I'd say 90 days, 120 days than we had in many years. That said, there is an impact for the terrace. In some cases, for example, we have a land site that we've had no money hard on, but we've been taking through entitlements and just spending those costs are there in Richmond, Virginia for industrial. We will likely acquire the land, and then we've looked at different scenarios. What if we build today? What if we build later? We can buy steel today at pre-tariff rates because some of the steel contractor, for example, has that. So you have more certainty in the short run than you do actually in the longer run, but that could all change. And so I think building in that flexibility is still key, and we're doing that. It is hard to make multifamily pencil. We're trying on a couple of cases where we have sites, but it's been much more challenging. These are all kind of in the greater Boston area where there's where rent growth is good, shortage of product, strong demand, but it's still, even then, hard to make some of these numbers work. I think we'll make a couple of them work, but it's again, it's really working with the general contractors, going down to the subs, working with the general contractor to try to extract the best pricing on the subs.
But we're also seeing a lot of people willing to sell the land cheaper than they were, that they're recognizing that if they don't sell to us, they're not going to find many other bidders out there.
Yeah, I'd agree. We are too.
It's an interesting time with supply pipelines coming down across asset classes, really helping balance from an institutional perspective the outlook, but yet incredibly challenging for those on the ground who are doing development strategies. But on that note, let's turn back to institutional benchmarks. And we were talking briefly about, over the last 20 years, how the NCREIF benchmark has changed from being primarily office and retail to now today to industrial and multifamily. Do we anticipate that those allocations will change again this year in any big way? Retail has certainly been the top performer recently. Is that going to grow this year?
We'd like to add more retail. I mean, we are adding some, but we'd like to add more. We've now found ourselves slightly underweight, and we'd prefer to be, closer to market weight or overweight. So it has been our top performer for about a year and a half now.
And what kind of retail strategies are your most favored?
We lean more towards, I guess, what you call community centers. So we're not doing. I mean, some are grocery anchored, but we do a little bit larger scale that might also be mixed use with residential components, or working with our manager partner to take down the larger parcel, and we'll keep the retail and maybe the apartment, and they'll sell off pads to other people, the hotel and things like that.
So we've also done retail recently. Part of that, I think, recognizing the shift in the benchmark composition away from kind of maybe the traditional asset classes and certainly office, but to embracing more of the alternative property types in medical office and student and self-storage and the like. And also being mindful of the fact that our client portfolios have gotten more heavily weighted towards multifamily and industrial. And so really kind of seeking renewed diversification around the margins where we can, but would be the alternative property cycles or retail, which is, as I mentioned before, finally feels like it's kind of at a rational supply demand balance. And so, retail is interesting again. And of course, it's not unlike office. The good retail is really, really good. Like, I'm not a shopper, but there is a retail shopping center that I will go to with my daughters because it's enjoyable, right? It's not your classic kind of outdated Class B mall. But I think just being mindful of diversification, given the run up in institutional, industrial, and multifamily exposures has been important for us.
And I think we've certainly seen a change in the retail tenant base coming through COVID. I think, Steve, you talked about that a little bit in our prep call.
I'm not sure that maybe I did. We don't do a whole lot of retail. It's not a primary focus for us. We actually have one retail asset in our latest fund, but we acquired the note. But it is more, it's more service oriented and more entertainment oriented for sure. People want to be entertained when they go out shop. It's not just going to get goods, because online can do that very, very effectively, but it doesn't give that experiential effect.
Absolutely. And I think, certainly the retail tenant today has endured a lot in the last 5 years. So I feel, it's a leaner, more efficient tighter use of retail space, certainly higher sales per square foot than we saw pre-COVID. So arguably a more solid fundamental backdrop to the retail asset class. Are you seeing similar trends, Hans?
Well, I mean, to build on that, Lisa, I think the context has changed a little. So as Christy was saying, that there's nothing like 15 years of no supply to help clean things up. I've been in meetings where we said, how many bars and restaurants can we cram into this before it's too much? And in many places we haven't found the limit yet. So that's been good. That's been helpful. But I think the context has changed. So if you look at the next decade, the average age of the millennials will be 41. And so that's the firmest ground I can stand on, right? We know that number's kind of baked. Well, what do you do with that age? Well, you're not like the millennials were when we had the screaming coastal apartment markets pre-COVID. At that age, you want to walk to work, walk to the bar, walk to the gym, meet somebody cute, and you don't mind sharing a 2-bedroom with your friend from college. And you don't care what taxes are because you're not making any money. So everything changes. You're 41, like you're paying your own bills. You are probably coupled up with somebody. You may have some, offspring going on. And so your desired square foot per person, it didn't just go from 500 to 1,000 when you acquired a spouse. It probably went to 1,500 or 2,000. And you're making money and you're paying taxes, and the context is all different. Your couch is not the couch you took out of your parents', basement. You own 2 of them and you bought them at the mall. So all of these things over the next 10 years start to look a lot better in markets that have that bodies times dollars math going. And that's a whole swath of the United States that has that going on, which really, bodes well for the type of redevelopments that Mike was describing.
Absolutely. So I think, as I think broadly about the market today, it's much more of a micro strategy than a macro strategy. Every asset class seems to have its own bifurcation and its own unique trends, but looking across to our institutional products, sector specific funds have been so popular and have really become a focus. What type of strategy is getting the most interest today?
Well, some of the areas that we're leaning into, I don't think we've discussed much, is data centers, senior housing, and we're continuing to, with private credit, real estate private credit, we need to keep putting money out because we're actually getting a fair amount of money back in from those. They tend to be 3 to 5 year type terms on the loans they put out. And then storage. We're doing quite a bit of stuff. There's also we did quite a bit of life science, and we haven't talked about that today, but there's a bit of a chill on that sector that's been getting chillier with the government funding cutoffs. So
we've also
Sorry,
underwritten
go
a
ahead.
handful of we've done some data center funds. In fact, it's really one of the only spaces that will look at development at the very moment. But typically not a lot of that is spec. It's generally pre-leased, powered shell type development. And then we've taken a more granular approach to the subsectors within the residential sector. So looking at things like student, senior, manufactured, build to rent housing, that sort of thing, and trying to diversify within that broader segment. Relative to the sector specific versus kind of broader diversified funds, we've had a bias towards the sector specific funds for a couple of years. Just feeling like we liked folks who are vertically integrated and could impact kind of the value creation at multiple steps along that asset's life cycle. We've recently kind of pivoted back towards including more diversified funds, just feeling like it'd be great to have capital in the hands of folks who are doing kind of relative value assessments in today's marketplace and trying to get some more information about where the opportunities lie. I think there's place for both in portfolios, but that's kind of been our recent kind of shift in thinking about those.
Well, that's music to my ears.
I would imagine you would not be sad to hear that, Steve.
No, it's interesting because we have always steadfastly said, hey, we need to invest across property types. And we have themes within each fund, like our current fund, it's primarily industrial self-storage, residential, primarily multifamily, almost all multifamily, and then science and technology assets, which are really workplace assets. And that has changed over time, but back in last fund and leading up to COVID through early COVID, if we had done a life science, and we've done life science since 2005, we were an early mover in that space. We had investors and we had consultants saying, you guys should just raise a life science fund. We didn't do that because it, quite frankly, would have made my job a whole lot easier in terms of raising capital, but we just were worried about the market somewhat. And we also thought that we wanted to find the best locations or really differentiated product. And if you have a sector specific fund, especially in something like life science, you have to go more all into the market. Same thing I would have said with, urban office back in, 2017, 2018. So we've resisted that because, we're just looking at, we've been in business 49 years. We want to stay in business at least another 49 years. And so that, we've done, but it has been swimming up time.
It's fair. I think if you're going to make a sector specific bet, you have to acknowledge the fact that you're making a market timing bet in some respect. And so, and I'm speaking mostly about pretty large, diversified real estate portfolios that can handle some concentration risk. But I totally see your point. It is a concentrated risk that you're taking with those types of funds.
And so what we've done as a result is we've limited our geography more, and because we are a fully integrated owner operator developer for the most part, not fully, but for the most part. So we've limited our geography because I think otherwise it's very hard to do. I mean, Heinz, some of the big shops can do it on a broader basis, but our geography is very limited as a result.
Well, sticking with strategies for a minute, debt funds have certainly been the focus of many conversations for the last couple of years, and we've certainly seen a sort of a misalignment between equity returns and debt returns. Does the opportunity for debt funds still resonate today?
I think since we're active in the space, we discussed this kind of maybe the tactical idea of timing, debt versus equity investments, and when Odyssey will come back to outperform debt. But on the other hand, I think we might be happy enough with our results of debt over the last 5 to 10 years that it's just going to earn like a strategic part of the portfolio, say in that 5 to 10% range, to always have some. And sometimes it'll outperform and other times it'll underperform, but it's kind of a diversifier to the mix.
So we've done structured investments in parts of our funds to date. So we raise one value add fund at a time, going back since 2009, and that has been our only product. Often when an opportunity opens up, like it did in 2023, we did 3 or 4 preferred equity investments because we just found it very attractive. We're getting return of our capital, slightly below mid-teens return on that capital, then participation on the back end. That participation on the back end has gone away. So I don't think it's quite as lucrative as it was. We are thinking about, do we do something longer term in the credit space at kind of a slightly lower risk, slightly lower return space. I think if we do anything else, that would be it. But, we haven't committed to doing that yet.
All right. I'm gonna cut us off here for a moment just to ask you each one question before we turn it over to the audience to see if we have any Q&A. But, certainly today's uncertainty has narrowed the focus for many of us to finding places in the market where we're confident in terms of where we're going to see cash flows. And the headlines have been dominated with downside risk. So turning to a positive moment in the market, I'm going to ask each one of you to give me your prediction for one upside surprise for the real estate market this year. I thought this was going to be an easy question.
Well, I would posit that interest rates can go down for good or bad reasons. And when interest rates go down, it's really good for core kind of assets. Certainly multifamily, they have agency debt, it's well funded, it can have a pretty direct relationship with decreases in interest rates. But then long leased assets as well. And interest rates this time, unusually, they don't have to go down only because they're a recession. So even if it's only 50 basis points and a little bit of a change of a mood, on the margin, that could have some good benefit to asset types pretty quickly. So I think that's the baseline that most people are calling for, a small decrease in interest rates. And if that happens, there are certain asset types you can predict pretty direct low benefit.
I like it. Thank you. Anyone else?
I guess I'd say we're not waiting for lower interest rates. It'd sure be nice. We'd love it. But, we're a bit of believers higher for longer. But I think the good news in the real estate market is the fundamental. I mean, Christy hit on it early on. The fundamentals are fairly strong. Supply is dropping. This, on again, off again, tariff news and Liberation Day is terrible, I think, for all investment businesses, not just for ours. Because uncertainty that doesn't bode certainty in the future is unsettling to markets. But it will pull back supply even further. And I think that with the exception of life science and maybe a couple other, smaller, more niche asset classes, we were not oversupplied, except for maybe multifamily in markets like Austin and Phoenix. But even there, it's pulling back that supply a lot more. So that recovery will then start to happen. So I think that's really the positive upside in the market.
I like the certainty theme too, because if we've had kind of a broadly speaking, a 15% correction to pricing, that's just all across all sectors, and you've got some inflationary impact to new development, new construction costs, call it 10%, let's just put a number on it. That's a pretty interesting delta between current pricing and replacement costs. And I think if we can get some certainty around interest rates or around general economic policies, that's an environment that real estate investors can play in. So hopefully more certainty is in the future.
I like it.
And
Michael?
for us, I think it surprises what I mentioned on the that maybe people have figured out how to underwrite office after a couple of years of major uncertainty, and they're starting to, in select submarkets, select assets, they're putting rent growth in and markets kind of stabilizing. So it seems like based on activity we're seeing, that we're actually thinking about taking some offices that we were going to sell and maybe holding them for another 2 or 3 years, because we think it actually is starting to get better.
I'm with you. My upside surprise was going to be that we're going to see meaningful uptick in transaction activity in the office market in a positive way.
It's important to have that sector come back, because it was a major sector, and to have it not come back. Even though we only own 2 office buildings today, we were very early and very strongly back to office because, a belief that we are better with it, we're better as a team with it, all those things, we're more productive, but also because we believe in the asset class long term. It needs to be part of the real estate asset class.
Thank you. Well, turning it to you, John, I know you've been curating some Q&A. Do we have any questions to throw out to our panelists? You're on mute.
John, need to unmute.
Yeah, we do have some, and we have about 5 minutes left in the presentation. And throughout the conversation, we talked a lot about underwriting volatility. Can you speak to the premium that this places on real estate returns for investors, and can that be quantified? And I'm going to piggyback on that with something else. Given the level of uncertainty, we talked about the lower yield spreads over treasuries that do not necessarily reflect the level of risk that's out there today or compensate for it. If you're putting together a DCF analysis, how should you figure out the reversion component of that DCF analysis? So two-step question. I don't hear any answers.
Well, I'll start. I think it's a really important question because it's hard enough to underwrite what's going to happen in the next year, let alone a 5 or 7 or 10-year hold period. So to me, this has us thinking about just a lower risk approach to real estate investing in today's markets. Kind of understanding what you can understand and giving a whole lot of optionality to whatever's going to happen towards the tail end of the hold period and for the disposition. And so, strategies like buying assets with interim leases, and you just have to hold them until they roll to hopefully positive market rent growth. Some of these things I think are much easier to underwrite today. And I'm not trying to take the easy way out, but I also am trying to take the easy way out. And, really just trying to know what you know and control what you can control. I think the reversionary values and that underwriting is super tough right now.
Yeah. And I would say for us, it's when I talk about, running your various scenarios and know what it is, know what that band of, and I think it's very similar to what Christy's talking about, know what that band of return is and be very confident with that band of return. If I delay development for 2 years and I have to hold the land that I'm about to close on in Richmond, Virginia, what is that return? What does that look like? I probably use flatter rents or declining rents for the first couple of years because I'm delaying that. I probably use a slightly higher discount rate, going to the second part of your question, versus I build today. What can happen with tariffs and understanding all of that, and maybe in the middle I build in 1 year. What does that look like? And I think that's the way we're approaching a lot of things, especially development and things that are less certain. I would say, on the other hand, we acquired 2 advanced manufacturing facilities, the healthy chickens that people were killing to feed their sick chickens. And we were buying these on a levered cash on cash basis in, 11, 12% range with long-term leases and the potential to expand the tenants and, and high quality credit tenant in one case. In the other case, one of the top defense manufacturers, they just raised another $1 billion in their raise. You will probably guess who it is. They're getting a lot of press. They're banked by KKR. KKR actually did the financing for us, which was unusual because we usually use bank financing, but we figured they had such a strong relationship with the company that was a good thing. It gave us further insights. And so that, you don't have to build, I think, in as much of a cushion because that, if you understand the tenants, you understand the use, and you can possibly grow that use, you've got a good return coming in, cash on cash, and ability to expand those tenants into the space over time, shows you your upside and your downside, and you figure out what is the tenant risk.
John, what I would say is that the question about requiring maybe increased return due to volatility, I think it's the increased volatility and risk is probably the same or greater in all the other asset classes, especially equities, but also fixed income, private equity, and all that. So, and you can even argue that some do that the 10-year Treasury has increased risk to itself over the over the longer term. So I don't think we need any special increased risk for real estate.
Yeah, and the risk could be different, or maybe more like the malaise era. To kind of build on what Michael was saying, people in the 70s and 80s bought real estate for the express purpose of hedging against inflation and to get the advantages of inflation, and that didn't change. If you look at a scatter plot of median household income against rent growth for office or apartment or even for the most part industrial, that fit is so good, it looks like I'm making crap up. If you look at it over a 10 to 12 year period, it works almost perfectly. Why? Because every box on the planet is a function, the value is a function of the amount of money that's spent to the building. Whether it's a hedge fund, which is going to pay a higher rent than a call center. So I think that for sure, the Holy Trinity real estate investing, the price per pound, the replacement cost, as Christy has mentioned, there's a good dynamic going there. The cap rate, which is a spread basis, and I would agree with what Michael said earlier. You know, spreads over the last 10 years are probably pretty consistent with the modern spread environment versus 30 years ago. And then finally, the IRR, which just falls out of your growth rate. I think all of those things are, you know, relevant to look at history, and it gives us a very good guide to how to look forward.
Well, thank you, Lisa, Michael, Christy, Steve, and Hans. As inveterate problem solvers, counselors of real estate are prepared and equipped to keep their clients and employers, to help their clients and employers capture opportunities, devise solutions to complex real estate problems. I would encourage you all to consider engaging a designated counselor of real estate to help enhance the clarity of your crystal ball, and when seasoned advice or a solution to a complex real estate matter is needed. Perhaps you might consider becoming one of us and seek for yourself an invitation to membership and the CRE designation, the badge of distinction, and a commitment to excellence. Please join us June 11th for part 1 of a special webinar on the Los Angeles fires, what happened and why. Part 2 will follow on June 18th. You may register at CRE.org. Until then, on behalf of the counselors of real estate, thank you for attending this session of What's Next for Real Estate and the Life Experience. We'll see you next time. Have a great day.